Lance, so great to see you once again. I mean, it's been a couple months since we've had your update. Welcome back to the show.
Housing, housing, housing. Always so much going on. And thank you for having me back.
Absolutely. So for those who don't know, this is Lance Lambert. He owns a company called Resi Club, which is a housing data analytics firm. And well, I mean, I'm going to give you an opportunity to, why don't you just give everybody that doesn't know who you are. And by the way, all of Lance's links are in the show notes below. Subscribe to his Substack, follow him on X. He has a lot to offer. But Lance, just tell everyone a little bit about yourself. Give them the little backstory.
Yeah, so longtime financial and data journalist, have worked at places like Bloomberg, Fortune. I was at Realtor.com for a couple years working with their data team. And while at Fortune Magazine, I was brought in to build out Fortune Analytics, which was a data platform and data newsletter for Fortune 1000 executives. And at the time, not long after I got there, housing started to take off during the pandemic. And there was a real need for better writing, better analysis on what was going on in housing. And so I just started writing about it a little bit on the side, and it started to take off. People really wanted to read it. It helped them to make decisions. They were understanding the market better. And I continued that through the mortgage rate shock, all of that. Actually back in spring 2022, one of the markets that I highlighted for the most downside risk was Austin, Texas's metro area. And I went through, based on its overvaluation, based on the amount of supply for multifamily and single family in the pipeline, and then also the likelihood of it getting hit by a negative demand shock from a rollover in migration, which had been so high during the pandemic. And that actually proved out correct, continued to build the audience. And then I left back in October 2023 to launch Resi Club. And we're a news and research outlet that focuses on the housing market. Our work is very data-driven, lots of charts, lots of maps. And then we have a data product called the Resi Club Terminal.
Oh, great. Like I said, all of Lance's information is in the show notes below. I want to give you a second to think about the question I'm about to ask you, because we're getting ready to dive into the data. We're here. It's spring. And but I want to ask a question. Can you define your thoughts about the current conditions of the housing market in 3 words or less?
3 words is tough. Okay, I'll try it. Affordability constrained, period, improving. So affordability got hit very hard during the pandemic housing boom, right? We had that really big overheating in home prices where we had all this demand from ultra low rates, stimulus, and then also work from home, which created more demand for space and also unlocked work from home arbitrage. And so you saw that domestic migration wave of people being able to keep their incomes in New York City, LA, Seattle, and buy in Austin, buy in Boise, buy in Tampa, buy in Jacksonville, buy in San Antonio. And so that really big overheating in prices was followed by a rate shock where we had kept rates too low for too long, and inflation had also, jumped up and surprised the Fed. And so we went into that rate shock, and between the two, the amount of money, the amount of income that it would take to buy a median priced home by end of, let's say October 2023, when rates got close to 8%, the amount that it would take to buy the median priced home was up about 88% from January 2020, right? So an 88% jump in the amount of income it would take to buy a median priced home. At the same time, incomes were up, 20-ish percent, right? Inflation was up 20-ish percent since January 2020. So not all of it was inflation. But that gap has slowly came down with rates coming down a bit, with home prices on a nationally aggregated basis kind of going something kind of sideways. We have seen that figure come down. And as of the latest print, it would take 78%, 79% more income than January 2020 to buy a median priced home. That's assuming they finance it, 20% down payment, no more than 30% of their income on the monthly payment. So a very conservative analysis. But even if you change those metrics, as long as you keep it apples to apples, that's what matters. And so it's 78% higher now. The income would need to be 78% higher, 79% higher to buy a median priced home today than January 2020. So that's down a little bit, right, from the peak, as mortgage rates have come down some, prices haven't gone up much, or they've been pretty much flat. And incomes during that same time have also continued to rise, right? So incomes now are up about 30% from pre-pandemic January 2020 levels, and inflation is up 26%. So the gap has narrowed some, and home prices themselves are up 44% from January 2020. So it's improved, but it's still affordability constrained. And so when you go out in the market and you look at what's going on this year, resale turnover is still going to be very low this year. It's going to be very low. Now, there could be some parts of the country where it's up a little bit, right? There could also be some parts that are maybe down a hair. But resale turnover has essentially been flat since second half of 2022. Turnover has just remained very flat. And we have seen in some markets new listings tick up a little bit, which has helped, maybe put a little bit of upward pressure on inventory as it's not being absorbed, right? Because at a higher rate, because resale transactions are still fairly constrained. But really, the biggest driver that's put upward pressure on inventory has just been that days on market has risen, right, in this affordability constrained environment. Now, where that's gone up the most, that's kind of varied, right? These Sunbelt markets have went up more than some of these pockets of the Northeast and Midwest, and some pockets of the Midwest, Northeast are still relatively tightish, is what I would kind of describe them as, compared to, especially their peers in the Sun Belt. But we have seen, so this year we're going to have very low levels historically of resale turnover again. And so existing home sales the past 3 years have really hovered around like 4.1 million for the year total, right? Back in pre-pandemic 2019, we did around 5.3 million existing home sales per year in 17, 18, 19. That's pretty close to a normal rate of turnover. During the pandemic housing boom, turnover jumped up, and there was around 6.1 million existing home sales in 2021. And so since then, we very quickly, by August 2023, we had evened out all of the excess sales. That had gotten evened out. And ever since August 2023, we are falling behind trend by 1.3 million existing home sales every 12 months. So we're now over 3 million fewer existing home sales for the decade than if the pandemic had never occurred. Like if the pandemic had never occurred, none of those downstream effects to economics and all of that had not occurred, that overheating doesn't occur the same, rate shock's not the same, we would have had 3 million more existing home sales on the decade net through today. So resale turnover still fairly constrained. The dynamics in these markets vary a lot. I will say that end of 24 into 25, there was a bigger burst of softening that was occurring in the market as inventory was climbing faster. And that the speed of the inventory change ever since 2022 directionally has went to getting back to pre-pandemic levels or rising, right? But the speed that it's done it, excluding seasonality, has been a bit of a stop and go process, right? 2022, the rate shock occurs, inventory jumps up very quickly, right? It started to spike. And then into the second, at the very end of 2022, rates came down a little bit. Prices in some of those bubbly markets probably declined faster than they should have because there was a big sell-off of the forced sellers at the time, which were the iBuyers, right? Because like Redfin was like, we're out of this, we're selling all this. Open Door had overpaid for a lot. They were doing forced selling. And so they were cutting prices on those homes every 2 weeks, right? As they were going down quickly. And so prices during that first hit of the rate shock fell a little too much in some of those markets relative to where inventory was. And then when rates dropped, what occurred is the market temporarily stabilized for a moment. And it created a head fake in 2023 where people were like, oh, the rate shock's gone. prices are going back up to going up 5-6% a year. And then as 2023 went along, we did actually see prices recoup all of the blow off nationally that occurred in the second half of 2022. But as the year went along, there started to be cracks that formed again. Austin had stayed in correction mode, but a few of these other markets that had stabilized, they started to see inventory rising again, right? That affordability squeeze had caught up to them, the rollover in net domestic migration. And so those markets started to see inventory rising. And then as you go into 2024, Florida goes into a firm correction mode, and they've still been in that, and I'll get into it in a second. Some areas in Florida are not softening and weakening like they were before, and some have improved some compared to then. But 2024, inventory's rising, Florida goes into correction mode, and then as you go into 2025, inventory's still rising, strong pace. More markets than just Florida go into correction mode. More of the Sun Belt is into correction mode. Many of the builders just frankly tell me the market conditions for 25 were worse than we expected. Lance, you were right. The inventory jump in 24 was a telltale sign of greater weakness for 25. We built too many specs. We have too much spec. And so that was kind of really felt in the Sun Belt. Now, as you go into 2026, inventory rate has decelerated. It's still rising some, and the builders have also pulled back on the spec. It's not the same circumstance where you had 24 into 25 where they had too much spec. They've now pulled back on the spec. They're like, we overdid it going into 25. Let's pull this back going into 26. They're trying to lean into things that have higher margins, like built to order. Wait to build it until you have the sale, right? And so they're doing more of that. And what we've seen this year is some of those weaker markets that had slipped into correction mode last year are kind of firmed up a bit, right? The softening burst has decelerated, right? It's decelerated, and the national rate of appreciation has really hit to zero. But I think that this is a where we have landed to is a place where if we stay right here for a while, we will see a healing for housing, right? Now, it's not going to be the fastest healing, but if we stay right here, where appreciation is pretty close to zero nationally, half these markets, 40% of markets are falling for prices, and inflation and incomes are still rising close to 3%. If we stay right here and rates, are down a bit and aren't rising more, we can see a healing for housing affordability. The housing affordability will improve. The speed of it will be slow. It's not going to be fast, but it'll be a healing process. Now, if we did see something that would occur, like a greater weakening in the job market, right, a recession hit, and there were to be a faster jump in inventory and prices fell more than is currently expected, we would see a faster improvement to housing affordability. Plus, also in that scenario, you probably get mortgage rates coming down more too. And that would be a faster improvement to housing affordability. But the current trajectory we're on, assuming that recession does not occur, will be a slow grind improvement to housing affordability. And so in 2025 was the first time in a while that we actually seen housing affordability improve, but it was very slow. And so that's my long-winded way of saying we're still in an affordability constrained environment. This market is absolutely feeling that. Buyers are really stretched on their payments, but we've moved into that part of the cycle where we're seeing an improvement in affordability. And the question will be, do we go on the slow grind to affordability, or do we go into a faster improvement?
I know locally here, as we're heading into March and even February, we did see sort of like a sales rebound. Now, I will say, sales are still very slow, but inventory is just not there. So we have this cohort of buyers that really want to buy, and the inventory that is hitting the market, it's getting absorbed very quickly if it's move-in ready. If it's beautiful, inside and out, the sellers did a really good job preparing. We are seeing a very quick absorption of that inventory. I'll give you an example. I just had one of my buyers sent me a listing that was kind of like outside of the area that they were really focusing on, but they have been looking for a house for several years. And they sent this to me, and I looked at it, and I said, they said, "Can you comp it out?" I comped it, and within the last 6 months, there was quite a bit of activity in the subdivision, many to compare it to, and it was about $100,000 over that comparable sale for the last 6 months. I called the agent. I said, "Look, I'm not trying to be smart, but I'm just asking you, how did you comp this house? I mean,
Yeah.
it looks nice online." And she said, "Well, before it'd been on the market for 2 days," and she said, "Before I go into that and answer that, I will tell you that I'm about to put it into pending status. We have an offer that the sellers are accepting." And sure enough, a couple hours I checked, and it was in pending status. And I'm thinking, what is, I think we have this buyer cohort that's out there that is just saying, you know what, I can afford to buy, and I'm tired of waiting. And if the house comes on the market and it checks the boxes and it's in good shape, but then you have the exact opposite scenario. I see a lot of rehabbed inventory where you could see, 5-6 months ago, it was purchased, and a couple months later, after it was rehabbed, it's put back on the market. And I'm seeing a lot of that inventory sit. And I'm also seeing a lot of back to actives, which is indicating, in fact, it's one of the things I've been working on. I just, on SachsRealty.education, we have a new course that's coming out in the next week or so. It's already been recorded on cancellations, contract cancellations, because nobody wants that. Even the buyers, they don't want it. Sellers don't want their contract to fall through. Buyers don't. But I'm seeing a lot of this back to active where the contracts have, the exuberance was there when it first hit the market, back to active.
Yeah.
And so, we're trying to educate people to say, look, there are ways that you can do better due diligence up front to not waste time. And for buyers, a lot of it's wasting money because they've had inspections and this kind of thing. You had said a couple things that I want to dive into about sales, existing home sales being about 1.3 million down per year over the last several years. And we are seeing that true, 4.1 about in 2025. I think the inventory delisting you're talking about, where the inventory shot up and it pulled back down, we did see a lot of delistings in the end of the fourth quarter of 25, where the sellers were like, "I'm just flat out not selling my house if I can't get this price." But we're not. I was expecting to see a lot of this inventory already on the market. If they took it off in October or November, we're in March, and I'm not seeing this big increase now, which is very concerning. So what are you seeing now? I mean, let's dive into the data. This video is brought to you by SachsRealty.education. Many of the costly mistakes that people make when buying a house can be 100% avoided. To learn more, visit SachsRealty.education and become an educated homebuyer today.
The market that you were talking about, is it Maryland?
Yes.
So one of the things about still a lot of these pockets of the Northeast and a lot of the pockets of the Midwest is that they're still so far below pre-pandemic levels that, a combination of just a little bit of a seasonality improvement as you get that seasonality jump, and, just any slight improvement in the market, maybe a little bit of a drop in mortgage rates, it can take one of those markets that has been softening, and it can put that supply-demand equilibrium, because it tightens up, into a place where it favors those sellers more quickly than, let's say, some of these markets in the Sun Belt. And so if you look at this map, anywhere that's dark brown is still close to 50% below pre-pandemic inventory levels. And by pre-pandemic, I'm using 2019 as a proxy. And so, there's still a lot of places that got to dig out of that. And if you go back in time, I'm in the Resi Club terminal right now. So if I go back, let's go back to, here's what it looked like in spring 2021.
Wow.
Pretty much the whole country is below pre-pandemic levels by at least 50%. So that means spring 2021, for every 2 homes that were for sale in 2019, most of the country only had 1 by 21.
And a lot more buyers.
Yeah, just overheating. Again, 22, super tight. After the rate shock occurs into spring 23, you can see that some had started to get out of it, but still fairly tight. And so when you had that market tightening just a little bit from 22 to 23, it then got that, the equilibrium stopped moving so quickly, and where it firmed up was in a place that still favored sellers a lot. And so that's why you saw some of that tightness reoccur into the market in 23. 24, digging out of it more. Then 25, this is that burst of softening that had really occurred from, in 24. Or sorry, I went too much. Okay, so here you can see 25. Then you really start to get that, greater amount of supply moving up in the Sun Belt. Still some of that tightness, right? Some of those places. And then this year, given the run up that we had last year, into a healthier place. But there are still some of these areas: Illinois, Wisconsin, Michigan, parts of Ohio, Indiana, Virginia, Maryland, Pennsylvania, New York, Vermont, Maine, Connecticut, New Jersey, Delaware, that are still have a good amount of this tightness. Now,
do you think that, just interrupt for a second, do you think that, so if we went back to like 2015 and 2016, are you still seeing those same areas that were tight, or do you think that this is something that is a direct relation to the ultra low mortgage rates at 2.75% and 3% mortgage rates that are creating this inventory sort of stronghold that a lot of people refinanced? They don't have to sell because, they don't want to give up those. It's like the golden handcuffs. They don't want to give up that mortgage rate. Or do you think that these areas were still that way in like 2015 and 16? Does your data go?
The regional variation today versus 10 years ago, very different, right? A lot of that time back into the 2015s, a lot of that was the run back up, the improvement, the rebounds in a lot of markets. And the places that had gotten hit hardest during the crash were improving the most, right? Las Vegas, Phoenix, right? Florida. And that stayed true into the pandemic boom. And then those places overheated even harder. And so some of what's occurred, some of the regional variation is the fact, and give me a second, I'll go to prices real quick. Some of this current regional variation is that some of these places that are a little tighter didn't quite see the same, overheating for prices. Some of those pockets relative to some areas in the country are still have greater affordability, even though they've deteriorated for the locals, still greater affordability than some other places in the country. And so some of them have kept more investor activity, whereas a lot of these places in the Sun Belt that saw this greater overheating in prices, it's really hard to find something that cash flows. You can still go into some of the markets in the Midwest and find properties that can cash flow. So that's a part of it, that relative affordability. And the other thing is the domestic migration turnover has went way down. And so right now, if you look at state-to-state migration, we are at historic lows relative to the past 3 decades. Similar to how we were 8, 9, 10, where the state-to-state migration had just rolled over. And so the places that had been seeing a good amount of that out-migration, some of these areas in the Midwest, Northeast, have stopped seeing that, right? There's fewer people leaving to go buy a house in Florida. Now, some of that is the lock-in effect, where around 1/5 of normal new listings and that resale turnover is kind of gone from the market. The only missing new listings in this market are the people who would like to sell and buy something else. And so for those people who aren't moving because switching costs are so high, of going from their lower monthly payment, lower rate, to a higher rate, higher monthly payment, for every one of those that's gone from the market, it's one fewer buyer and it's one fewer seller. But where that lost buyer is and where that lost seller is could be two totally different places. So if you're in Maryland and you otherwise would have sold your house to go buy something in Florida, but you aren't because the math doesn't make sense right now. Because you could even go to Florida and downsize and somehow end up with a higher monthly payment than your current monthly payment in Maryland. So some of those people are staying put. And so they're staying put, and that's one lost seller, one lost home for sale in Maryland, and it's one lost buyer in Florida. And so the lock-in effect is still at play, and lock-in effect, some people don't like the term, but essentially what it is there's affordability constrained level to a chunk of the turnover, and it affects supply and demand. But where it can affect supply and where it affects demand could be two totally different places. So I think that we're just in a unique moment for the housing cycle, which we always are. There's always a tremendous amount of nuance and variation within the housing market. Now, what is unique is that national appreciation is pretty close to zero at the moment. If you look at some things, maybe it's slightly down, maybe it's slightly up, pretty close to zero. But whenever national appreciation is close to zero, you will have about half a market's up and half a market's down. So for us to be at this place right now, it makes a lot of sense given the overall macro moment for the housing market.
Where do you think the best buys are right now?
Well, one thing that we're seeing is that we are seeing the inventory burst to slow down. So some of these areas in Florida that had went up a lot for inventory and have seen prices fall, many of them are down. If you go along the coast right now of Florida, you will see that inventory in many of these markets like Lee County, Collier County, down in Southwest Florida, Charlotte County, a lot of those places that are in outright correction modes, they are starting to see inventory fall a bit. Now, it hasn't necessarily translated into a big tightening for prices. We are still seeing prices fall some, but it could suggest that those markets, are closer now to the bottom than they were. And so if the math, starts to make sense, some of those places might be worth looking at. I think a lot of it, though, it comes down to, people doing the math themselves. What does that home cost? What would their monthly payment be? How much money do they have to put down? And then look at, if they took that monthly payment, kept it in stocks, if the divergence between what they would pay for the home and what they rent, if they took that amount of money and put it in stocks, and it appreciated at a slightly below average rate, because you always want to be very conservative when you do those, figures when you're estimating stocks or even home prices or rents, and then compare that to what you would be paying in your monthly payment, and then potentially any equity built the next 10 years. Take those numbers and see how the math looks. I think that people should do the math is really the biggest thing. And I think that long term, I'm still optimistic on many of the growth areas in the country. While the growth areas are down at the moment, I think that there are certain types of housing bets that are going to be good if you stay in some of these higher population growth markets. Now, those investments for home building will probably be better than they will be for SFR. SFR is still very challenged. But if you're a builder, even though some of these markets in the Sun Belt are seeing prices fall right now, some, and are kind of going through a recalibration, it's still probably smart to stay where the long-term population growth is. So the Texas Triangle, areas in Arizona, Florida, Georgia, South Carolina is the fastest growing place in the country for population. If you look at a lot of the metrics for like net domestic migration still. And so that's a very challenging question for me to answer, because I think the math, depending on your situation, can, veer it a lot. And also the type of bet you're making. If
We're seeing a lot of back to office too. I mean, I talk to people all the time, and they're like, I'm called back into the office 5 days a week now. They went from the hybrid model to full-time back. And so that has really impacted a lot of people because a lot of people that uh, moved states because they were working remote full-time. I mean, they've really been hammered the most with this because a lot of them have been forced to get other jobs.
Yeah, we've definitely seen that. We're seeing a pullback in work from home. We're still well above remote work levels and work from home levels of 2019. We're probably not going all the way back to 2019, but we are seeing a slow rollover. And it'll be interesting to see in some of these cities, at what point does it start to create, that greater tightness again for the urban cores? Because a lot of these urban cores of DC, Manhattan, District of Columbia, San Francisco, they have been very weak. Now they're deep exurbs, deep out in, further out into New Jersey, Connecticut, the places that people didn't want to live, during normal times. But now that they only have to go into the office maybe 2, 3 days a week, maybe even one, they're willing to do that longer commute that they would have never done 5 days a week. And so those deep exurbs of those major metros have been fairly tight and have seen much greater appreciation than the urban cores. And actually, some of these urban cores, it's kind of crazy to say, for some of the condos, they're actually condos now are selling in some of those areas for less than they did in 2018, 2019, even despite all the inflation that's occurred. So as we see some of that, work from home slowly dissipating, at what point do we start to flip? And some of those deep exurbs maybe went a little too far, right? And now they go into a bit of softness. And then some of those urban cores that have been soft for the past 6 years, maybe they start to regain some of their tightness. But at the moment, those deep exurbs are still, at least around like New York's metro and DC's, they've still retained some of their tightness.
I think it was in 2023. I could be wrong. It may have been in 22, but I think it was in 2023, about mid-year, or maybe it was closer to the third or fourth quarter of 23. There was a lot of talk about baby boomers. The silver wave is, I remember there was an article on Yahoo Finance, and they were saying that there was an expectation in the next 5 years that we would see about 30 million baby boomers going into retirement. And the thought was that they would be downsizing and getting rid. I mean, look, I know locally utility costs have gone through the roof. It's been a very cold winter and people are getting their utility bills or heating bills, and it's been crazy. And I mean, a lot of these have big houses. What do you think that they just underestimated the fact that people are holding on and more active today and healthier today, and that they, I mean, baby boomers, a lot of them do have wealth. You can't say that every baby boomer is wealthy. That's certainly not true. But I think they do hold a big portion of the nation's wealth. Do you think we're going to see this wave of downsizing and moving on, and maybe see domestic migration increase over the next couple of years? Or do you think they just completely missed the mark and underestimated the viability of a baby boomer staying in their home?
Yeah, I think that a lot of that wave of migration from the boomers, probably their last biggest jump was during the pandemic. And I think that since then, given where the switching costs are and the fact that to downsize, you could actually have to pay more if you're financing the purchase, which is kind of wild on a monthly payment basis. I think that probably not as much there. But what we have just entered is going to be a period where the baby boomers are going to put upward pressure on turnover in the market, It hasn't came into the macro data for housing at the moment because we're at fairly constrained levels of turnover, but they will be putting upward pressure on it, and it'll come through one of the D's of housing, which is death. And I could actually share my screen and show you the data if you're curious.
Are you tracking, Lance, while you're pulling that up, are you tracking where the most price pressure is as far as like square footage of homes? Like I see the 2,000 square foot home locally seems like there's the highest demand for something like that, 1,700 to probably 22 or
I do it by
2,300 square feet.
tiers on price. I don't do it by tiers of square foot, but I could do it that way.
Yeah.
That's
Yeah.
a good suggestion.
Yeah. I mean, it would be interesting because, you think about the baby boomers. I mean, if they have a four or let's just say upward of 3,000 square foot house, maybe it's 3,500 square foot of finished space. I mean, that's a bigger cost to somebody, especially if they're in the entry level. They're not looking for something like that. And I'm seeing sort of like the biggest, at least in our area of Maryland, I'm seeing this big demand for the smaller houses, which is mostly driven by first-time buyers. They're millennials or Gen Zs that do okay financially. They have good jobs, but they can't. I mean, they couldn't afford a 3,500 square foot house. They couldn't handle the maintenance of it. So we're seeing a lot of. I've always had this sort of philosophy where all luxury homes are kind of overpriced. It's kind of hard when you're getting into the. And I know for me to say, $3 or $4 million house here, and somebody in California listening is going to say, well, that's not great here. I mean, it's not such a hot house. We have a high demand for that because we have $15, $20 million houses. But I think if we look at our DMV, when you start getting up into that $2, $3, $4 million price range, it seems like I'm seeing that kind of is weak. And where we're seeing where the buyer could get the biggest potential price cut from somebody. It's like I said, I mean, it's once you start getting into a higher priced inventory, beauty really becomes in the eye of the beholder. Not so much when you're looking at, hey, this house is move-in ready. It's 2,000 square feet for $550,000. That seems to be like still flying off the shelves.
And can you see my screen here?
Yes.
Awesome. So what we're seeing in the data is that the biggest upward pressure on supply and turnover in the U.S. housing market from the deaths of baby boomers is not actually the moment we're in right now, but we are in the upswing. And so the biggest pressure is actually the start of the 2030s. And so if you look at the data, in terms of if you take their birth years and you apply it to actuary tables of expected deaths, what the data comes out to, according to Freddie Mac, is that this is the figures that they estimate for the annual decline in number of baby boomer homeowner households. So this is not just deaths. This is actually the contraction and the number of baby boomer homeowner households. And so 2023-24, it was around a 300,000 contraction. This year, it'll jump up to around 500,000 for the year. But by the beginning of the 2030s, it's close to 900,000, close to 1 million. Now, this is very just isolated to the baby boomers. So this is not just all, homeowner household contractions. So the jump is actually a little misleading because you still have the ones that are contracting right now that are the generation before them, right? The silent gen. But there will be a uptick in upward pressure on resale turnover and supply potentially for new listings in the start of the 2030s. The silver tsunami isn't just an all at once, but it will be a gradual upward pressure on resale turnover and new listings, and we are starting to move into that window. We haven't seen it translate into a big impact in the macro housing data. right? Resale turnover is still fairly low. New listings are still fairly suppressed. But that's also because of the housing cycle that we're in and the moment we're in for the housing cycle. But as we move through this period of recalibration and we go into the start of the 2030s, there is going to be more of this supply coming into the market.
I guess I want to get your opinion on, if somebody were to say to me, "Hey, Todd, in 3 words or less, how would you describe your opinion on the housing market?" I would have to say, in one word, surprised. I think, as somebody that has been serving the housing market for decades, and as a builder, investor, contractor, uh, real estate salesperson, and for a couple decades now, and broker, I'm really surprised at the we haven't seen a bigger decline in home prices. Are you?
Well, I think if you look historically in terms of like a bigger national decline, uh, not necessarily, because if you look at historically, if you look at the housing market asset class, big nominal declines in national home prices are rare outside of great financial crisis or outside of a financial crisis and a subsequent depression, which is the Great Depression and GFC, where you did see it. And there was, also other factors where we probably not only tightened lending to take out some of those shadier products that, helped to lead up to a greater level of transactions occurring at the top of the market, '05, '06, and then subsequently put greater downward pressure on the market. We not only got rid of some of those mortgage products, but we maybe even tightened lending a little too much. And so, the average credit score jumped up 70, 80 points in 2008. And not only did it jump up above, and knock out some of those subprimes, but it jumped up above 1990s levels, early 2000s levels when it was a normal, healthy market, or in the 90s. And so that greater tightening, it did a couple of things. One thing that it did is that it really busted out the single family. It helped to create a bigger bust for single family home building than would have occurred. We were always going to have a correction in 2008, 2009, 2010. But the fact that we went through that and we also tightened lending, which created a greater shock downward, right? And so then we have a greater crash home. And then, builders couldn't even build, if so many of the, so much of the single family new construction was just blown out. If you look at housing starts, single family completions. And so we went really far below trend. And so then when you have this moment where, during the pandemic, we had a greater overheating, prices went up too much too quickly. You're able then you still have this need for single family homes, right? You still have this need for more single family homes. And so builders, yes, prices went up too much. They were able, though, to do the affordability improvements and then meet the market, because there was still a market. There was still a demand for these single family homes. So I think some of the fact of the greater, the overcorrection that occurred during the crash created a subsequent echo effect that left some lingering tightening to the market. That's part one. And then the other part to it is, because there was that bigger tightening to lending, not only did we take out some of the too risky profiles, but we probably took out a good amount that probably maybe should have gotten in, but we just took them out, who would have created some of that lever of some of the, forced selling in a normal housing cycle. And so we took out the very risky, but then we also went a bit deeper and cut them out too. And so I think if you look at this housing market, there's just not a ton of stress in the market. Yes, you can go look at the FHA and you can subset them out and you can find some stress there, but it's still not broad based. If you look at the cycle, the homeowners themselves, they are the strong hands. Affordability is out of whack. Yes, absolutely. But the homeowners themselves have still had stronger hands through this cycle. And so I think that that has created some greater resiliency to prices. And
Yeah.
so where we have seen some of the improvement, though, is through a a correction that has not necessarily been in nominal house prices nationally, but is occurring because house prices aren't going up that much nationally. They're pretty flat, and incomes are continuing to rise. So it's been a healthier improvement to the market. Now, there are still some of the parts of the country that have the boom bust cycles, the Austins, right? Some Southwest Florida, but that is actually normal to have some parts of the country that go through that. You had that in the early 90s when you had parts of the Northeast and parts of Southwest or Southern California and parts of Arizona that went through a correction, while a lot of the rest of the country went sideways. If you go back into the 80s, the middle of the 80s to the late 80s, you had a correction in Texas. San Antonio, Austin, Dallas, Houston, all of those places had their own. Now, a lot of that was also downstream from economic effects at the time in those markets. But that is kind of healthy to get into a place where if you do have a correction, house prices nationally kind of go flat, but then some of the markets that overheated too far go through their own correction. So this has been a much healthier correction for housing and a much healthier normalization period. The downside to it, though, is that because it's going so slow, it's going to be bumpy for a while. And we're going to be in this affordability constrained market for a while. But to answer your question, I think that that's kind of like the core of it is that homeowners themselves this cycle have had stronger hands. And I think that there has been some lingering effects of the fact that we just had too little single family home building from 2010 to 2015. And by the time single family buildings started to ramp up, there are supply capacity limits of how fast it can grow. So even though there was a very clear demand for more homes 14, 15, 16, 17, 18, as the market had improved, the industry could only grow so fast because a lot of the guys who were working in the industry, they not only lost their careers, a lot of them ended up losing their homes too. A lot of the people who foreclosed were in the construction, real estate industries because they got hit so hard. And so a lot of them were like, you know what, I got burnt too much. I'm out of this. They changed careers. And so as you started to ramp up, there was labor constraints. There was also, entitled land development constraints because even though the market had improved, coming out of that recovery of 2012, 13, 14, you then only had so much land that was ready that was entitled because there was just a blowout there. And then if you zoom out further, there was only so many, there was only so much lumber, so much windows, so much all of the supply, that whole supply chain had gotten blown out because the correction had just been so deep for single family home building where you had the correction 8, 9, but then you just 2010, 2011, 2012 just took so long to get it going back up. And so I think that there's still lingering from that.
Just to follow up a little bit on that, back in 2006, the peak before the 2008 crisis, your housing market index was still hovering right around 100, meaning that a median household income could afford, even though prices were at the highest peaks that we had seen historically back then, the housing market index was still around 100, meaning that if you had a median priced or a median salaried household income, you could still afford a median priced home. But then we watched the builders, and you and I have talked about this too, and you had even mentioned that a lot of what the builders did was they catered to the ones during the housing crisis that had the money, that weren't affected by a downturn in the economy. I mean, some people, it was a nothing burger, right? That 2008. I mean, they don't even remember. And then you have the cohort that was living with mom and dad that are buying houses now, but back then they didn't feel it either. But the builders started building bigger houses. So we not only saw in this go round when we hit the 22 peak that the HMI, Housing Market Index, had dropped beneath 100 for the first time in a while. And I think it was down in the 90s, meaning that the median household income couldn't afford the median home price. But then not just that, but the home prices have doubled
Yeah.
since then. I mean, we had 2.75% mortgage rate. So home prices now are priced in that 2 and 3 handle. And then we have higher taxes, higher insurance now. Home repair costs and maintenance costs are very much more expensive than they were just 5 years ago. And like you said, the rent versus buy metric, it's definitely more affordable in a lot of the markets to rent, maybe many of the markets to rent than buy. I mean, you're even saying, hey, maybe look at taking that extra money that you would use for a down payment and investing it and just rent. So I guess that those are the in analyzing that information is kind of like the biggest surprise for me that we have not seen it. Now, yeah, I agree with you. I mean, a lot of people are saying, hey, the FHA delinquencies since the waterfall effect ended November 1, that affects the ability for them to get a loan modification. They have seen a double-digit increase in of what I've been hearing, and delinquency rates. But yeah, that's a very small cohort. But I think the what we're seeing here is that we're just not seeing the inventory that would command any kind of more of a price correction. I think that we've seen so much equity in the pre-2019 owners that have purchased. But I can tell you, I am seeing a huge percentage of the houses that are for sale and coming on the market right now are not ones that have had their homes for a while. They're ones that bought in 21, 22, 23. And a lot of them are trying to get, 10 or 15% more than what they bought back then. And, we'll see if they get it.
Yeah, and I think the other thing though too is it also varies a lot across the country. And so as home building started to come back, back in, 12, 13, 14, started to ramp back up, a lot of the builders had went out of business, especially the smaller builders. And the ones who did stay in, a lot of these bigger builders who need volume to maintain, they need scale, right? And so if you need scale, you're going to the places where it's easier to entitle land, where population's growing. You're going to those Sunbelt markets. And so a lot of like your market, some of these Maryland ones, I'm guessing if you followed the trend, and you can see this through the Northeast, you probably haven't had much building for the past decade. And a lot of your smaller builders, many of them didn't come back. You probably have some infill here and there, but you didn't have that building, right? Because and so some of the places have gotten back into a much healthier amount of construction supply, right? Some of these Sunbelt markets, and those are also the places that have seen a healthier improvement in affordability since rates went up so much, right? There is that supply elastic response where demand went up a lot, prices went up a lot, and so that gets followed by a subsequent supply, right, that comes to meet that, right? You've seen that in some areas, and that's helped those areas soften more. But there are big swaths of the Northeast and Midwest in particular that just haven't had that. And builders, haven't been there for a while, right? They don't have that supply elastic response. And some of those places, that's why not only have they not seen a greater, correction, some of those places have actually inched up and have higher prices than 22, despite rates being, having doubled since then. And so there is still a lot of, regional variation to some of the narrative that I gave you.
What are the home builders telling you? Are they starting to consider now building smaller houses? Are they turning some of these subdivisions that have already been approved to a smaller building footprint? Are they expecting 26 to be good or like 25 or worse? I mean, what are you hearing from the building executives?
I wouldn't say they expect it to be good. They probably expect, from the ones I've talked to, kind of more like boring, but they're not going to be caught off guard. Like 2015 or 2025, some of them were caught off guard. The market was softer in some of their core markets than they expected. And keep in mind, whenever I talk to builders, the commentary I get skews to the Sun Belt because that's the epicenter of home building, right? The South has 39% of the country's population, but the South has 59% of all the homes being built. And so when you talk to the big builders, it's going to skew to the Sun Belt. And so a lot of them had pulled back on spec in the softer markets. So there's less of that. And then their peers have also pulled back. And so that makes them a little hopeful of, that the market isn't going to, see a much bigger burst up in supply than they expect. But there is a lot of, they're doing the things that they can to get volume. And so, yeah, some areas they've leaned into some more of the smaller builds, but so have their peers. And so, if you look through the Sun Belt, where you see the greatest amount of softness right now is actually the bottom of the market. Where some areas in the country, it's the opposite, but there it's the bottom of the market. And that's because that's where the most spec has been built, is like a Lennar or DR Horton tries to, keep up volumes, right? Whereas the top of the market in some of those Sunbelt markets is a little more resilient. Uh, like a Toll Brothers is doing a little better than a Lennar. And
They're catering to more of the wealthy population.
yeah, and then incentives are still high. Incentives rates are still high. Uh, you have had in the weakest areas, they've had to go further than just incentives. The buy downs have not been enough, so they've had to do outright price cuts. The buy downs are now a little bit less expensive for builders because rates have come down. So that could also give them some more affordability adjustment room. You had AMH, which is one of the largest institutional single family landlords in the country, say on their earnings call 2 weeks ago that some of the builders are buying out the leases of their tenants if they'll come buy a home from them. So you're still seeing very like savvy, aggressive types incentives. You are
Interesting.
not seeing a huge blowout in volumes. You're seeing a rollover in some of these weaker areas where they're pulling back some inspects, but you're not seeing like that 8, 9, 10 like real floor drop. So it's still been a healthier recalibration period. You do still have some of that echo effects of all that multifamily and BTR supply that came into the market that created some greater softening. You still feel some of that. And so you do still have some of these areas in the Sun Belt that have some of the, softer rental markets. But if you flip it and you go to the areas of the country that don't have the home building, right, that haven't had the building, you can find a much different story and still some of that tightness in the market, given that inventory has not built up as much, which is why, while I'm not like a full blown NIMBY, let's just build everywhere, we can easily solve affordability, build. It is true that you want to have some supply elasticity in your market, right? You want to be able to have, if you do have an overheating for prices, you want to have builders ramp up. And in the places that don't have that supply capacity, they don't have the new construction, they don't have the presence of these builders, they haven't had as much of that. And so they've still stayed a little tighter.
Yeah. As far as the rates, mortgage rates, what are you expecting with? I know when we spoke last fall, we were kind of talking about maybe we would see this improvement in the rate, but any indication that we're going to see something where mortgage rates could be back in the 4%, or do you not expect
Well, I
that?
think when we were talking about some improvement for rates, that's when they were still kind of closer to like 6.5,
Right,
6, 7, right?
right.
At that point, there was still more room for rate improvement because the spread between the 30-year fixed mortgage rate and the 10-year treasury yield was still so high. But we have seen improvement there, and that spread has really narrowed. And so if you look at the drop in mortgage rates over the past year and a half, 60% of that is due to a compression in the spread. And so, MBS just slightly becoming a little more relatively attractive to, bond investors than it was a year and a half ago. And so what occurred is that when rates went up back in 2022 and they were spiking, not the spike that occurred for the 30-year fixed mortgage rate and for mortgage rates was much faster than the bond market as a whole for treasuries. And so the spread got really wide. It got up to around 300 basis points, 3 full percentage points. And normally the spread is around, 1.75 percentage points, 175 basis points. And so that was about 125 basis points too high. And so slowly that's come down. We're now around like 1.95 percentage points, 195 basis points, 200 basis points, 2 percentage points. So still slightly higher than normal, but it's compressed so much that the wiggle room or the optimism to go lower purely based on spread compression, there's just not as much optimism for that now because we've already gotten it. And the 10-year Treasury yield, it's still around 4%. You have seen some softening in the labor market. Inflation, though, has still been, a little higher than Fed's expectations. So there isn't like a huge expectations for, the Fed to go from, it's already gone from restrictive to kind of neutral policy. There isn't as much of an expectation now to go from neutral to easing because while the labor market has softened some, inflation is still a little above target and the labor market has not broken. We're not seeing a big spike up in labor. And so given those factors, I think that you can kind of expect mortgage rates to kind of stay close to where they are, right? Personally, I would not be expecting if I was a buyer out in the market, like a huge, I would not have a really big optimism on a really big mortgage rate drop unless something bad happened to the economy. Then in that scenario, you probably do get mortgage rates falling faster than expected. I forecasted, I reached out and I had around 20 housing economists and economists take my housing economist survey heading into this year. And I think that the average, actually, let me just pull it up. That way I don't guess. So among the 21 mortgage rate forecasts tracked by Resi Club, the average prediction is 6.18 for the year for an average. Now, I should mention that when you hear these average forecasts for mortgage rates, keep in mind that in a normal year since 2000, there has been around an 87 basis point difference between the highest mortgage rate reading in a given year and the lowest mortgage rate given year. So when you hear 6.19, that does not mean that all through the year it's 6.19. We could have 6.4, 6.5. We could go down to 5.8, 5.9, and that still could be a correct forecast. So one thing that, people get a little uneasy with, just keep that in mind. And then, so last year was the first year that mortgage rates were actually pretty close to forecast. So when I did my roundup in the end of 24, heading into 25, the average forecast predicted that by the end of 25, we would average 6.33% for the mortgage rate. We ended up averaging 6.23 for fourth quarter 25. Now, when they made that forecast, we were around 7.1. So they ended up directionally being correct. That was the first year they've been pretty close to accurate in several years because the mortgage rate forecast in 22 were the worst the biggest miss ever for mortgage rate forecast, right? At the end of 21 into 22, mortgage rate forecasters were mostly calling for mortgage rates to tick up to 3.6 to 3.7, 3.8, 3.94, right? And at the time we were around like 3.1, 3.2, 3.3. So that would have been a jump in mortgage rates. What ended up happening is that for the year, we ended up averaging over 5. and the highest reading for the year got up to over 7. So it was a big whiff. 23, heading into 23, they expected mortgage rates to drop more than they did. Mortgage rates actually rose. 24, they expected a bigger drop. It didn't occur. For heading into 25, they called for the drop, and it finally happened. So another thing is with these forecasts, you have to take them with a grain of salt, because to get mortgage rates right, you actually have to have gotten the overall bond market right. You have to have gotten the inflation. You have to have gotten the economy right. You had to have gotten the job market. You had to get the global economy. So there's a lot of factors. And often, if they're right, it's because they got lucky too. So I would take that with a little bit of grain of salt. Even the things that I say about mortgage rates, you have to take them with a little bit of grain of salt. There could be circumstances that occur that I'm not necessarily foreseeing, but I think all things considered, I think that the best guess is to assume that mortgage rates are going to stay fairly close to where they are today, and there isn't as much of an optimism for a bigger drop, given that the Fed has already moved to neutral, and given also that the spread has also narrowed so much.
So tell us what's going on with Resi Club, man. What have you what's 2026 hold for you? I know you added a lot of products last year that broaden your ability to provide this great housing data, but anything new in the pipeline?
Yeah, so building out the Resi Club terminal, getting more people access to it, selling it to more firms, working on that. I have a conference called Resi Day that I'm going to do again in November. I do think that Resi Day, ended up providing some unique insights into 26 that was kind of unique relative to some other events. Not that I like to lean into the policy stuff as much, but I did lean into it for my conference last year because I thought that a lot of the other conferences weren't really having a good pulse on it. So we had Bill Pulte there. A lot of the things that Bill Pulte has announced this year, if you were at Resi Day, it would not surprise you. And then another thing that I leaned into heavy because I expected there to be a greater push to regulate the institutions this year is I had Sean Dobson from Amherst there, which is one of the largest institutional owners of homes. We had a big discussion on BTR and all of these different aspects and what regulation could look like there. We do have a lot of things coming down the pipeline right now. I haven't been on my phone for the past hour during this recording, so who knows what the Senate's already done, but they are considering a bill that would ban the institutions, those owning up to at least 350 single-family homes, from being able to acquire more homes in terms of like scatter site resale. Now, there would be exceptions. If they go out and they buy a home and they spend at least 15% to repair that home, so they're adding a value right to the marketplace, they then could purchase it. If they buy it from a builder or they build a build to rent community, they can do that too. But if they acquire through the 15% greater renovations, through build to rent, or also foreclosure, the exemptions, then they have to still sell the home within 7 years. So they can keep all their portfolio that they've already acquired before the bill, but they can't acquire any new resale homes unless it meets the exemptions. They can still build to rent, but if they do acquire new homes or through the exemptions, they have to sell it within 7 years. And so where that's creating controversy is that a lot of these build to rent communities, they are, the way they're plotted is not that, it's not, they're done more like a multifamily deal. And so then to sell them, they would have to be converted into condos, and it would create, a lot of, what it would do, it would create a chilling effect to capital deploying to build to rent. And so some people, maybe some people don't want build to rent. They don't want those types of communities. But those who do, they're doing a big push now to see if they can get Congress to get rid of that 7-year exemption or the 7-year sell-off for new build to rent development. So we talked about a lot of things like that at Resi Day, and that's kind of
Yeah.
where my mind is figuring out what's going on for housing, both in the market and then also some of the policy stuff and changes.
When you were just talking about the build to rent and you said they would have to turn them to condos, so are you saying that institutional investors would not be able to build? I think of when condos, now I do know detached single family houses can also be under a condo regime as well. There's HOAs and condos, and some associations there's both. Where your house, you have a homeowners association and a sort of like a master plan or condo association, or vice versa. Maybe you're in a condo and there's a master plan HOA. Are you saying that the institutional investors are not going to be able to build apartment buildings?
No, they can still build apartments.
They can still, right?
Yeah,
That's what
and
I'm
I
saying.
think
Yeah.
that it's what it is, and I would have to pull it up. Give me a second.
But you were saying that they'd have to convert their build to rent associations into condos.
Let me actually just read this quote from Jay Parsons. He's a rental housing economist. Uh, How does it crush BTR? And this is a quote that I'm reading. How does it crush BTR? The bill requires BTR owners sell the homes to individual buyers after 7 years. Who is going to invest in construction projects that have a forced sale in 7 years? BTR communities are typically being platted on a single parcel. That means the homes could not be sold off as individual homes without converting to a condo structure, which is messy and adds enormous uncertainty. Few, if any, BTR investors will want to take that risk. Notably, the bill
Hmm.
defines single family as a structure that contains two or fewer dwelling units that are each intended for residential occupancy by a single household and only excludes manufactured housing. So presumably that excludes attached townhomes with 3+ attached units, effectively treating them like multifamily apartments, regardless how they are
Hmm.
plotted. And then he says,
Wow. So that's what I was. So you were accurate in what you're saying. I appreciate that clarification. So just for everybody listening, so the builders that do the build to rent communities, um, they can only keep them for 7 years, but prior to starting the sell off, they would have to convert that community into a condominium association, which really, and I can understand that because if you think about it, in that regime would have to be responsible for all exterior of that house, not just the landscaping, but probably the siding, the roofing, you name it, concrete sidewalks, everything else in between, including landscaping. But that's interesting. So they would have to convert it to a condo association before they could start their sell-off, and they'd have 7 years to consider doing that.
so I think that that point of the law is where a lot of like the tension is this week, is figuring
Yeah.
out, like, what do they do there? I think that the institutional ban for them buying just like scatter site homes, I think that that'll probably end up going through with these exemptions. But I think that the biggest thing that is getting worked out is what they're going to do for BTR. Are they going to actually make these be sold off in 7 years? Because that is going to be challenging to get capital to still deploy to them. So if you're willing to do it as written in the law, you have to be willing and on board for there to just be fewer of the BTR. Now, some people
Right.
might be like, you know what, I'm fine with that. Do fewer. Hopefully, the for sale market, pulls, makes up for that slack. But you also just, you have to assume the risk that would actually occur.
Well, it's really funneling them into, if you want to invest in single family rentals, it's funneling them into a more of a clear path of they just can't go out. I can remember when we were in like 2021 going into 22. I mean, I know title companies that were working with these institutional investors, man, they would buy as many single family houses as they could possibly get their hands on. I mean, it was like, 10,000 a month. That's great. That's how many we want. So let's find the houses to buy. So, and that really did put a stress on owner occupied dwellings because, I mean, like a third of the sales were investors.
And so let's say that you're on board with taking out the institutions from buying scatter site homes. You're like, you know what? During the pandemic period, while it's not a huge percentage, there was an upswing in it, right? And it came at, maybe the worst time because there was already all this demand that came into the market. And so let's say you're like, okay, let's get rid of that. But on the other side of it, it's like, okay, if you get rid of the scatter site, which yes, did come in and bought homes during the pandemic, in the resale market, we're competing with buyers. But if you take them out from the BTR side, one of the things that was healthier about the institutional capital, whereas like, buying the scatter site, that was competing with the buyers, but the capital that got deployed into BTR helped and was a part of the subsequent supply elastic response in the market where we've gotten into this softer period, right, where affordability is constrained, but some of the supply that's came in to help to heal the market in some of these areas, has been this multifamily supply where a lot of institutional capital backed it, and also some of this BTR supply. And so that, I'm not trying to make any, hard stances here, just kind of, laying out some of that other side of it too.
Right. Now I get it.
Well,
Lance, we always appreciate you coming on. I'm sorry it's been so long. I mean, we've been developing on our side. Like I said, we've been when we were talking before we got started here. We're really excited. We have a couple great courses that are coming out, so we've been really diving into heavy on the education side. But it is so nice to see you and have you back, and I look forward to getting back onto our regular schedule and keeping us updated on what you're seeing out there. And I can't tell everybody, can't even stress enough to follow Lance. He's always putting out just solid, non-biased, factual data, and we appreciate it so much.
Todd, housing. Happy to come on anytime.
All right, we'll talk to you soon. Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.